What's my edge in oil trading? Conviction. With Sparta Curves, I get real-time, trusted prices from 30-plus top brokers. Futures, swaps, physical, and freight, all in one place. Switching from Bloomberg or Refinitiv only took 15 minutes, zero disruption. Now, our whole team runs on one flow. Sparta Curves. 45 days. Free. No risk. No friction. Just conviction. Start your free 45-day trial by visiting spartacommodities.com/curves.
Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Welcome back to the Sparta Market Outlook Podcast, so your weekly snapshot of what's driving the global oil markets. I'm your host, Rachel Williams, and this week we have Neil, June, and James on the call. Hello, everyone.
Hi. Hey.
So another week, another big spread of headlines. First off, we have to go through the latest EU announcements on Russian sanctions. The market doesn't see it as very impactful for the physical crude right now, and that's probably justified. But there are some nuances that we want to pick up on in the background for both crude and products. So then we're going to dive into the physical world of oil as usual, including a crude market that still isn't showing signs of OPEC flood, and a distillate market that's simply relentlessly strong at the minute. But for how long? So let's get started with the big headlines on sanctions. So Neil, June, picking your brains on this one. What do we think about the impact on the market today?
Yeah, I'll go first, and June, you can pick it up afterwards. Yeah, so the big news obviously was the new sanctions from the EU. And to be honest, the market is doing the right thing, as you might have expected beforehand. So it's fading a lot of the initial headline risk. And rightly so, there's the perception that it doesn't really change much about the physical market on crude in the immediate term, right? So it's got more sanctions on banks, more sanctions on some more vessels. The price cap essentially, and it redirects flows into the dark fleet, and it's kind of like a rinse and repeat of the previous times we've discussed this kind of thing. The only other thing I want to pick up on is that I think there's some sort of geopolitical messaging in the background. I want to pick that up after June's had her say on the matter, but there is a bit more hawkishness from, let's say, combined US and Europe on the Russia story. I think we picked that up last week as well, but I am getting a bit more convinced. So that's the one thing we can take away, maybe.
Okay. June, what about the refined products ban, if we can call it that, actually? Can you give us your thoughts on some of the feasibility around that?
Well, first of all these sanctions won't take effect until the 21st of January of 2026. And also the details of the products ban is yet to be determined. It would be interesting to see how these EU guidelines will come out to be with the point on oil product tagged to crude origin. If you think about the refineries, they all have many crude tanks in the refinery, and there are so many ways to blend the crude once it's brought into the refinery. Thereafter, it's up to the crude scheduler on how to create the best blend to fit potentially multiple crude trains for different secondary units' final production. So theoretically, the refinery can segregate out this 100% of Russian crude into one crude tank, feed this crude tank just for non-EU destination purposes. And then the kero and the diesel that comes out from the crude can also be further segregated and not flow into the EU destined regions. However, the residue from this crude, from the Russian crude, would go to other secondary units like the FCC, the hydrocracker, the visbreaker, the coker, and further produce light product. Then these products would have so-called undergone transformation. It could again depend on how they classify this. It might not be classified as Russian crude origin anymore. So then this can be further blended with the non-Russian crude origin, and there's whole complication about blending and origin. So summarizing this, you basically can blend down all the Russian origin products with non-Russian origin to almost very small percentage. And of course, once it gets into the hands of traders and blenders, there's even more creative ways to bypass the origin issues. So my view, as long as there's no outright ban of the oil products that come from refineries with any receipt of Russian crudes, enforcing origin or proof is likely ineffective, and therefore the gas oil and Carol may still flow into the EU.
Interesting. Very glad that
Yes,
you're
very.
our in-house refining expert, that's for sure. I also really liked your LinkedIn post where you shared a little bit more on this as well. So Neil, you've been thinking this week about the wider geopolitical messages. You touched upon it earlier. Do you want to loop back in on this one?
Yeah, I can go. So, I mean, also just tagging on to what June has been saying, what's the point of doing this then? So either it becomes symbolic, or they go the full bore and basically just said any refinery that takes any Urals or whatever becomes on the blacklist or something like that. But there's still a couple of loopholes left over, right? Because there was this list of countries which included the US, among others, where basically it wouldn't count as a Russian origin barrel if it was first imported into those countries. And the second thing was there was this amendment that said if a country is a net crude exporter, then any Russian origin products coming out of that country would not be classified as Russian origin products, right? Which is a kind of an interesting little detail. And it makes me think, I'm not quite sure what the origin of this amendment is, but it makes me think they're leaving a loophole for Russian crude to go elsewhere, because obviously the idea behind this is that they want India and Turkey and possibly China, but it's not going to work, to stop buying Russian crude.
Yeah.
But they want, again, the volumes to stay on the market somewhere. So where does it go? And I'm just listing things out in my head. Maybe it goes to Brazil as a net exporter of crude, or maybe it goes to Dangote, for example, although we've just been discussing that internally today. It's a different story with their RFCC. But it kind of strikes me that they still want to leave loopholes out there to keep Russian crude on the market. Against that, you got a lot of really hawkish messaging this week, also again from Scott Bessent, who was urging the EU to follow through on the US threat to put the 100% tariff on buyers of Russian crude. So I don't know quite where I stand on it. It really sounds like the US is getting more hawkish on this thing, and it ties in with more peace negotiations and Trump getting more annoyed at Putin. I don't know where I stand on it. I think the short-term geopolitical risk is going up, and then I don't know what happens in terms of these sanctions, let's say, as they stand.
It sounds like, I mean, this is going to be something that we're going to be talking about kind of over the next couple of weeks by the sounds of it anyway. So one to keep an eye on. So look, guys, last one on this then. Let's game it out. So if there was somehow a way to ban Russian origin products from Europe, what would be the impact on this? So Neil, James, which one of you wants to take this first?
Go ahead, Neil.
Okay, the long and the short of it would be, it's another one of these classic trade flow redirections. It's not that there's not enough capacity on the market, in the freight market or in the diesel market relative to where we are today, although we're still tight. It's just a case of you need to get the right price set up to redirect these flows, right? So it would require a wider east-west on diesel, because you want to pull in barrels probably from the Far East now.
Yeah, indeed.
And the Indian barrels go elsewhere, and probably you want the US to fill in a bit more into the European market. And you get Indian barrels presumably going to places like New York and LATAM even. So you need Europe to price up in order to make that happen. And it takes time. That's the main message for these things. If it would happen and they announced, next week we're going to ban this thing properly and it's enforceable, you would get a big spike on gas oil ice spreads. You would get a big spike on the east-west. And it would take a few weeks to get all the supply chain rushing around to solve the thing.
Yeah,
James,
it's interesting on that point, because it's the redirection. I guess really we're talking about the redirection of Indian cargoes probably into like Latin America. But actually we've had Brazilian customers on asking us about our ARB calculations in order to source non-US diesel into Brazil of late. And it's not just the anti-Russian sanctions by the EU, but also the reciprocal sanctions between the US and Brazil that is also going to restrict the amount of US diesel that Brazil can take as well. So Latin America seems like a natural home for these extra flows from India.
Okay.
And then probably increase US flows into Europe as well.
Okay. Well, James, I'm going to follow up with you kind of on the distillate section on this in terms of what's happening kind of with Europe and where have we moved off from last week. But thanks, guys, for the section. So let's finish off with some of the bits of news this week. So what about the May Jody release? Anything interesting come out from that?
I'll take that just very quickly. No change in trend really in terms of the stock levels in crude and products, right? So we're still in a tight place. That's fairly clear. No demand collapse as far as I can see. And the one interesting bit to add is we really saw the effect of yields as we've been talking about the last few weeks, right? So the European gas oil yield was very low, the lowest seasonal level in quite some years, and half a percentage point down on last year at this time. So even though we got the first increase in runs versus this time last year, we actually had lower gas oil supply. And the opposite is seen on gasoline. So there's that really strong gasoline yields in Europe in the last couple of months. And that goes together with what we've seen, right? It's kind of a confirmation that the combination of whatever maintenance pattern was plus the slates is actually constraining diesel supply quite a lot in the US and Europe just now.
Okay. Anything else? We also had news from Prax as well. Can't remember if we touched on this last week, actually.
No, it was the headline 2 or 3 weeks ago, but it turns out it looks like it's going to shut. So it's another, just James Free, it's another 120 kpd of refining capacity shutting, added to the list of big shutdowns in Europe this year, basically. And again, a reason to be bullish east-west, I guess, or generally it's a bull factor for Europe over the next couple of weeks.
It is. Yeah, it is quite
interesting with these refinery shutdowns. Maybe that's part of the reason why they've left kind of loopholes for Russian produced diesel to flow into Europe, actually, because they've got less ability to produce it themselves.
Yeah, to be fair, Lindsay was actually quite a decent gasoline kind of making machine as well. So the impact on the gasoline potentially kind of US PAD 1 will be an interesting one as well. Also, just surprisingly, they give it such a short kind of space to be put up for sale and to find a buyer. Typically kind of, assets of this size take a good kind of 6 months for a buy-in cycle from my experience. So given it 2 weeks, yeah, it was a bit of a short, sharp kind of turnaround from that one. So let's see if the UK Gov can do anything about that. Okay, so lastly, other things that we've been talking about this week, there are headlines about Chinese teapots restarting. June, any news on that one?
There are actually 3 ChemChina teapots that went bankrupt last year. They've asked for crude import quotas from the government this time round. One of them, called Shandong Changi Petrochemical Company, was acquired by another company called Weifang Hongrun, and they already restarted ops in late June using domestic crude, which they don't need to apply for crude import quota. Combined capacity of these 3 teapots are 300 kpd. Is there a question of higher margins or perhaps more capability to import HSSR? I think we track back to maybe December, was it December, that Teapot's announcement that, we had difficulty to find economic feedstock because, number one, fuel oil import tax went up by 2%. There was additionally changes in the consumption tax rebates, and there was also a clampdown in Iranian imports. And don't forget, there was also sanctions on certain teapots on this as well. But in the recent months, we hear in Shandong, there's already a pilot undergoing a review on the consumption tax rebates, kind of to give a little bit more incentive for the teapots to restart again. So why would it happen, right? These independent refineries, they are actually a lifeline to many of these provincial governments, and they help to support the local economy. Whereas the overall big government wants to clamp down on the teapot. So it's a bit of a regional versus government play here. But whatever it is, it looks a little bit bullish crude on this instance because you might have that extra 300 kpd of capacity coming back online. And obviously this points to even more crude imports from China.
Okay, excellent. June, I'm going to keep you talking for the next point then. So we've just gone through the headlines. So what about physical oil? So starting with you, June, as I said, so we're midway through the September Asia crude cycle. So what can we take away from that so far then?
Just to align again, where are we now? We are in the September loading barrels trading now. Melbourne, surprisingly, is holding out in terms of the premium, even in the face of WTI and CPC up competition. Brent Dubai has narrowed to about $1 per barrel levels. Last week it was 160. TD3C has stabilized versus the week before and currently at SEP Dubai plus 310 on the Melbourne. The cracking margins are looking at 450, very strong. Simple margins on Melbourne is close to break even at about 40 cents. Fundamentally, there's no change. This is the period when we expect more OPEC barrels into the market. When summer burn is over, Asian turnaround season starts in October. So I personally hold a bearish view still on the AG Spotlight crude premiums. SEP Ice Melbourne, where I looked at, was at 330. I feel there's more downside to this. On the Ice Bourbon, just to highlight, is actually at 215. So we do see that effect already in the following month's IFAD number. Also on the indicator margins for Southeast Asia, August margins currently looking at $3 per barrel. The complex margins at $11 per barrel. So the spread has further widened to $8 per barrel from complex versus simple versus our 3 weeks ago podcast at $7 per barrel. So what does it mean? Number one, refineries will still push hard to run in Asia. B, simple margins is still also okay to run on discretionary basis. So with cracks strong, this will actually incentivize refineries to hedge even forward positions beyond the current trading window, and therefore it's a bit of a watch point for the rest of us when we are looking at Q4 cracks. If the margins come off, but the refineries still run anyway.
Okay, Neil, can I get your, and June actually, can I get your thoughts on kind of the risk to Dubai weakening in that case?
Yeah, I mean, it's really just that it's quite interesting the way that this cycle has gone, right? So June's just been saying that essentially the Dubai market has held up really quite well.
Yeah.
And at the same time, Brent has been weakening actually, which is kind of the reverse of what the expectation was, right? Because as June said, September is the time where we should start to see a lot more OPEC exports after summer burn. So I'm also of June's view that, that fundamentally speaking, we should be seeing Dubai weaken, but it's not happening yet. So it's kind of the question of why. Is it because we're still too early in the cycle? Or is it that OPEC exports are actually, or the market doesn't see OPEC exports as really rising that much? Is that how crude really prices? I guess not really. I think, June, what you're saying is that, they're happy to fill base load at these levels of spot premiums with margins still pretty good. And then maybe in a couple of weeks' time, we start to see the marginal effect of, okay, now we're looking a bit long towards the end of the cycle. And there's an expectation that, we can see that OPEC exports are rising and the flows and that kind of thing. There's still time for the Dubai market to weaken. But yeah, I think it's quite interesting. It's not happening yet. And it goes with my story that I think OPEC won't export maximum levels because the market will see it and they don't want flat prices to go any lower. So for me, it makes logical sense. I'm not saying I'm attributing it, but it makes sense just now.
Okay. All right. So one to watch then over the next couple of weeks as we move into the buy-in cycles a bit further. So Neil, what's happening in the rest of the crude market? You've got a couple of points to make looking at kind of our chats this week.
Yeah, I'm just trying to figure out why, following on from this, why is Brent weakening? And I'm not sure I have the answer yet. I think there is a small paper effect. So obviously we're running up to the threat of tariffs on Europe. I think the market's getting more concerned about that. We've had quite a bit of flat price and spreads over the last few days because the market's thinking about that and also fading the Russian risk. So I think there's an effect there. But you can also see in the physical market in the West, the light sweet fobs are coming off. The resid shortage looks like it peaked already a few weeks ago. So a lot of the, let's say, medium and heavy crude markers that we can see in the West have come off quite strongly. Sverdrup was one. It was massively bid up this time 2 weeks ago or even a week ago, and now it's fallen off a cliff. Guyana looks also quite cheap. So those crudes are arbing east now, in fact, together with the EFS. And you can see it in the Canadian diffs as well. So the Hardisty diffs, the Gulf Coast Canadian diffs. So it looks like the resid shortage is over. So maybe there's just less, say, competition overall in the Western Hemisphere. And as you mentioned the other day, Rachel, maybe it's just the start of a weakening buying picture ahead of maintenance. It feels to me like that's a bit early still, but maybe it is. So I don't know, fundamentally, I'm not quite sure where I stand on that, but at the moment, there's a lot more west of Suez crudes that are arriving into the east now because of the combination of these things. So that means more competition into the east from ARB crudes and getting presumably more ARB crude starting to move east out of the west. So it kind of makes sense fundamentally that from these levels, Brent Dubai should actually start to widen again over the next few weeks, let's say.
Okay.
But that's, I think it's low conviction. I think I learned my lesson over the last year of trying to make predictions on the EFS. But I'm just trying to say directionally it would make sense that actually we see some reversal here.
If it's
Okay.
any comfort, the traders that I talk to also find the Brent Dubai EFS is really difficult to trade.
Yeah, I was
Yeah.
going to say maybe if you were going to open your book, let's not start with that. But you're right. I mean, one of the things that we can do over the next week is we can talk a little bit more to the market just in terms of what September kind of European maintenance is gearing up for and where are we kind of on the buy-in cycle there. I do wonder kind of if that comes early that or starts to be early, then people are just delaying kind of making those decisions for now. We've also got summer holidays kind of coming up as well, don't forget. So anything else to add there before we move on to the clean side?
No, I mean, maybe one more thing is just a bit more availability of WTI. So you can see it in
Yeah.
the EIA data, right? So there was a big lull in TI exports in prior weeks, and it looks like it's rebounding. I guess it's going to rebound further again today in today's data. So maybe there's just also a bit more TI availability in Europe as well.
Yeah.
And that makes sense with the ARB picture that we saw over the last 4 weeks, let's say.
Yep. Okay. All right. Thank you very much for that then. So, James, good to have you back
Hi.
again this week.
Hi.
Just following on from some of your trade ideas last week, how's the distillate market moved? And can you give us a quick run through of what's been going on over the last few days?
Yeah, well, I don't want to repeat what we've spoken about like over the last few weeks, but okay, the general theme in the diesel market is that stocks are low globally, essentially, especially in the Western Hemisphere. We spoke about that at length in the podcast before, and Neil kind of highlighted some of the causes of that already. So, light crude slates, lack of resid, has led to high gasoline and high jet yields, particularly in Europe and the US. So the general feeling that we have is that we should continue to see diesel cracks need to remain elevated in order to incentivize diesel production, particularly as we move into that autumn turnaround period that you just kind of discussed. On top of this, and probably more pertinent over the last week, we've seen that last Friday saw the announcement, as June was talking about, of the enhanced anti-Russian, sanctions and anti-diesel Russian sanctions as well. These, as June kind of spoke about already, these aim to sanction petroleum products made by refineries and companies that take Russian crude. And yeah, the threat is pretty clear to kind of Indian diesel cargoes and jet cargoes as well. But as we've seen actually towards the end of Friday, as we found out that this was going to be delayed until January 2026, the strength has mostly dissipated in the global distillate markets at this point.
Okay, that's fair. So where do you see European middle distillates go from here then in that case?
Okay, so I don't want to attribute it all to the view that we made last week, but ice gas oil spreads and cracks have increased over the last week, as we did discuss.
Yep.
But in most part due to those anti-Russian sanctions.
100%.
I don't agree with 100%, but mostly.
99%.
So this has been enough now to open or point arbs from both the US Gulf and the Middle East West. And as we've heard from customers and seen from some of the tracking, we've seen these arbs have been moving through the Suez or via the Cape in increased number for a while. So this should only add to that, really. I think we should see that continue to put a ceiling in ice gas oil spreads and cracks into the short term. And something we've already started to see, that ice gas oil spreads and cracks have started to come off maybe over the last 2 days or so. European jet has its own issues, really. So as we said, continually high jet yields and the weakness in the Singapore regrade market that we've been speaking about for a while actually means that all Asian origin jet arbs, so even the Middle East and the Far East, even Southeast Asia, are open to the Europe currently and are only increasing their margins. So the weakness in European jet seems that it's going to continue as well. So I guess a bearish view overall for European distillates, really.
Okay, fair enough. So we're off your bull run on...
Only in the short term, but yes.
Yeah. Okay, all right. What about the US, James?
Yeah, let's talk about US jet because we don't really ever do that, really. So kind of mirroring Europe, we've seen like stellar jet yields in the US, probably since the start of or end of Q1, really. So the US jet diff is following Singapore regrade. It's moved like its lowest level in like the 8 years if you kind of discount COVID numbers, essentially. We've actually seen the US jet arb, US Gulf jet arb open into the med for parts of the previous fortnight or so. So the outlook for both US and European jet continues to be pretty bleak. Now, heating oil spreads, counter to what I said last week and probably supporting Neil's view, have also gained over the last week or so. And that's been despite open diesel arbs from Asia into US West Coast and West Coast LATAM. We haven't really seen those fixtures really pick up. And the reduced diesel exports into Brazil, because much of this has been staying in the Med, has also meant that Brazil has been pulling on the US Gulf pretty hard as well. However, I think the heating oil strength And the fact that heating oil has moved up and the wide east-west means that, for example, West Coast India arbs and even AG arbs have been open into New York for periods of the last week. And I think that should put a ceiling in heating oil spreads into the short term.
Okay. All right. Let's finish the rest of the world then. What about East Asia?
Yeah, so again, probably a similar story. As we predicted last week, Singapore diesel spreads and cracks have gained, but much of that has been due to those geopolitical issues we discussed already. So we've got a situation now where Middle Eastern diesel cargoes are open and pointed west, particularly on jet, but also on diesel. And we've got North Asian diesel cargoes that are pointed, because of the heating oil strength, are pointed trans-Pacific now. Added to this bullishness is kind of that view that we just discussed on East Asian jet, which is very, very open into Europe as well. So we should see overall middle distillate stocks, but also particularly diesel stocks in Singapore reducing over the next period of time. So I expect this strength in MOPS 10 ppm diesel spreads and cracks to continue into the short to medium term.
Okay. Neil, do you want to interject here? There's a lot that James has covered there, so I kind of need him to summarise a little bit, but what are your thoughts?
I wanted to ask you guys a small curveball question. The good thing about podcasts, you can always edit out like a 30-second pause in case we need one. But like, I'm looking at the regrade, right? It's outside of COVID, it's definitely one of the weakest. I mean, it's the weakest regrade since pre-COVID. So like, is it a sliding, how does it work? Like, is it a sliding scale where even from here, the weaker the regrade goes, the more jet you can blend into diesel? Or is there, I mean, there is obviously a volumetric or percentage limit, but have we already hit that limit with this regrade? Do you understand the question? I mean, because obviously we've got these light slates, we've got way too high jet yields. Yeah. We need to put more jet into diesel, if you know what I'm saying. What do you guys think as refining experts?
Gosh, yeah, Neil, you're literally testing kind of my 20-year memory now of actually kind of blending distillate. June might have something further, but there is a physical limitation about how much jet you can actually blend into diesel. And I can't remember whether it was on flash or maybe seating. June, one for you.
It's flash.
So there is a physical limitation where you'll hit kind of a certain limit that you just physically can't blend anymore in. You're literally, I'm scrabbling around now to work out or remember what percentage that is, but it's not an endless game. June, have you blended anything recently?
Very roughly, it's about 20% max into jet into diesel. But I'm also thinking from the MoGas angle, right? Another way that you can reduce, or why we are seeing more Caro in the market, is it because of the weakness in MoGas as well? So then it's the cut point change between the heavy naphtha and pushing more into Caro. Yeah, because if you don't need the octane from the platform 8, then you don't need to run the heavy naphtha, then you push it into Caro instead, which gets you potentially better value. So I'm just wondering whether it's also a MoGas weakness story here.
Yeah. Good point, actually.
Sounds good.
Yeah, maybe we want to follow up on next week on the clean side. We'll get Jorge back on for that one and pick Miles's brain at the same time. So James, you talked a lot. We did a bit of a whistle-stop tour throughout the world. Can you summarise for our listeners really what your position is on this now?
Yeah, I was just going to say it's amazing to have like those kind of other commodity owners at hand that you can ask those kind of questions. I think that's really great. But this, in summary, so moderately bearish ice gas oil spreads and cracks on the back of somewhat increased diesel arbs into Europe, mostly into the short term, because we've got the overhanging issue of low diesel stocks globally. Very bearish on European jet pricing, on the back of high jet yields and large arb arrivals. This is a Western Hemisphere issue, so just Europe and the US, really. Moderately bearish heating oil spreads and cracks on the back of challenges for for the US Gulf into its kind of typical homes in the US West Coast, New York, and Latin America, essentially. And bullish seeing diesel the cracks and spreads really into the medium term, really somewhat reduced arb arrivals and more of like distillate molecules leaving the region. Although the stellar refining margins is quite a strong caveat to that.
Okay, I'm going to certainly track kind of your change to the bullish picture. We probably won't see that kind of for quite some time by the sounds of it, or at least kind of going into the maintenance season. So thanks, James. Guys, do you just want to wrap up with what's happening really quickly in the other markets, in the other commodity markets today? So a bit of a quick fire session. Who wants to take this one on?
Yeah, I can do it. Just asking the other guys, as we can't have 10 people on every week. That's a bit busy. I'm just asking him for, what do you think is the most important thing to say this week? One of them's from fuel oil, right? So, and it tags on to what we've just been saying. So contrary to what it looks like in the crude picture, where Dubai is strong and Western resid looks like it's peaked and is easing, You have the opposite picture still on the high sulfur fuel oil market, right? So if you look at the 380 east-west, for example, it just gets worse and worse. It's very, 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 very wide. And so it's not solved on the fuel oil side. So this will have to kind of correct itself or eventually. And one of the issues that has been encountered is that you are expecting more Middle Eastern, basically molecules to come out of their post-summer burn, and the east-west dictates it should flow west, but we haven't heard much about that yet. So that's basically one of the main solvers is going to be when fuel oil burn reduces in the Middle East. And of course, that brings me back to the Jodi data, which told us that the fuel oil burn in Saudi Arabia in May was extremely strong. I don't know if that's carried on through recently, but it looked very, very strong. Also crude. The other one is from the light ends, right? So now we have a very quick roundup on gasoline. The EBOB situation looks particularly weak, let's say. So there's a lot of bearish things adding up. The first is that the TA ARB massively declined. It's pretty much a story of, if you look at the pad one stock picture, it looks extremely bloated. I mean, that's not something I think that's something we've picked up on last week as well with Phil, but it looks very bloated now. And on top of that, basically in the Atlantic Basin, Houston is the cheapest barrel in most export locations. And on top of that, you have the AG, which is now much more competitive into places like WAF than we have seen for quite some time versus ARA. So there's just this bearish list that's mounting up for EBOB or for the ARA complex. And again, linking that also back to what we've been discussing this last hour, it doesn't look like a big rescue for the gasoline market anytime soon, generally speaking. And also over in the east, the eastern gasoline market looks very well supplied in terms of pricing. And, basically one of the main solvers we are thinking about or wanting is the highly anticipated Chinese export quotas. So we haven't seen what those are going to be like yet, but in a sense, the market wants a slowdown in Chinese gasoline exports, and we want more diesel, let's say.
Yep, fair. Do we know when the quotas are anticipated to be released?
It was supposed to be in July, so anytime now.
Okay, all right. Watching that avidly. I'm sure, Jane, you'll have a snippet out on that kind of ASAP. Okay, great roundup this week, guys. So I just want to get from you guys just a trade idea or two, or at least some directional indications in the market. We've covered a lot today, so just a quick summary of what are we looking at kind of this week going into the rest of summer periods. Who wants to go first?
All right, for me, it's the spot SEP loading AG light market. I'm bearish and therefore looking at ICE Melbourne on IFED to come off further from current 330 levels.
Okay. Neil?
I'm going to, even though I mostly agree with that, I want to say something contradictory and just say that the stupid EFS is going to widen again. That's my contribution this week. There's some kind of contradictory thing like that, but not very high conviction. I just have this feeling that it's not going to do what everybody expects.
Fair enough. James?
Yeah, so what was I? I was bearish the west and bullish the east, essentially. So I guess I'm thinking the east-west should find floor now. And so I'm bullish the east-west. That's what we're looking at.
Okay, brilliant. Looking forward to seeing how Neil's EFS trade plays out next week. We'll be certainly tracking that over the week. So look,
happy to be proven absolutely wrong.
Absolutely wrong, yeah. Okay, look, thanks for tuning in to episode 50 of the Sparta Market Outlook podcast. We've officially hit the big 50 and certainly ramping up kind of, I know, and certainly ramping up to 52. How time flies when you're having fun. So huge thanks to Neil, June and James for dropping some serious market wisdom and a few unfiltered takes. If today's episode made you smarter, bolder or just slightly more bearish, don't keep it to yourself. Like, subscribe, share it with your trading desk, your boss or that colleague who still thinks that RINs is a vitamin. Next week, rumour has it, that we'll continue diving into the wild world of the light distillates. We'll also try and grab some gasoline insights, and June will leverage off the fact of your comments on how gasoline and some of the cut points on the crude tower kind of shift around. So buckle up kind of for next week. Until then, keep your charts clean, your margins wide, and your market views unapologetically Sparta. Thanks, guys.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.